The Mars family, the Waltons, the Rothschilds, the Agnellis. All these families have one thing in common. They are owners of a business that has survived for multiple generations and in fact has thrived over decades and in some cases centuries. They're not the first families to think about businesses that are dynastic in nature. So what has made them successful? Well, it may not necessarily be what you think. By watching this video, you're going to learn the following. First is that many, if not most, family businesses are one bad transition away from losing everything, and you may not even know it. We're going to study 3 dynasties that have figured out the formula for multi-generational wealth. There's also a governance tool that almost no one talks about that reduces family conflict and protects the enterprise. By the end of this webinar, you're going to leave with a risk management framework that you can apply before your next ownership transition. It's a common misconception that the families that are able to sustain their family enterprises over long periods of time, decades or even centuries, do so by focusing on preserving their wealth. They focus on a culture that generates wealth from generation to generation. And this isn't just so-called business best practices. We're going to show you that this is the case with math. It's commonly understood that wealth that is created in one generation, if it's passed down, is used up by the 3rd generation. We call this the shirt sleeves to shirt sleeves phenomenon. According to data from the Family Business Institute, something around 12% of wealth that was created in the 1st generation survives the end of the 3rd generation. And some studies indicate that only 3% remains by the 4th generation and beyond. Now I promise you some math, and one of the math reasons for this phenomenon is that every generation divides the pie into an increasing number of smaller and smaller pieces. If we assume 3 heirs per generation, the original wealth in the 1st generation becomes a 4% sliver in 4 generations. That means that the value of the enterprise must grow several fold just to keep the value constant for each family member generation to generation. And this isn't even factoring inflation. If we assume a relatively modest rate of 2% inflation over 30 years, if we factor in a relatively modest inflation rate of 2% per year over a 30-year period, $10 million at the end of that 30-year period has the purchasing power of roughly $5.4 million currently. If we assume a more realistic inflation rate of 3% over time, we can see the burden that inflation imposes on wealth creation. For example, again, just to maintain purchasing power parity over time, if there are 5 descendants in the 2nd generation, the business enterprise must be worth at least 2.5 times the value of the 1st generation just to maintain the value of each individual share. This means a real return of 3.73% or a nominal return, which is a more realistic measurement, of 6.84%. And we can see that these returns remain constant from generation to generation, at least within a reasonable margin of error. But we haven't factored in any of the costs of running these businesses over a long period of time. If we assume that a generation is equal to 25 years, and initially there are 2 descendants, a family must multiply its wealth by 50 times over the course of a century just to hold per capita wealth constant in purchasing power terms. And this is before we even discuss wealth leakages such as taxes, distributions, philanthropy, family office expenses, and investment mistakes. Once we factor in the real-world costs of maintaining the family enterprise over time, an even greater burden of return is imposed on the asset in order to sustain family wealth. Even if we assume a relatively low drag, a family enterprise should expect to spend roughly 1.5% of its wealth each year on taxes, family office costs, charitable giving, and family member distributions. A more realistic drag might be 3.5%. It's not unusual to encounter family businesses that have a drag as high as 6.5%. Because of the return burden imposed by the financial markets and the realities of operating the business, family businesses simply cannot afford to maintain a minimal risk posture because the returns will not be able to sustain the ongoing needs of the business as well as the distribution needs and wants of the family member shareholders. Once we combine these considerations, a low friction family, meaning a family with a relatively low operating overhead cost, needs to generate 9.33% annual return over the long term just to maintain its level of wealth, whereas a moderate friction family requires an 11.33% return in order to sustain its wealth level over time, and a high friction family requires a 14% rate of return to sustain its wealth over time. These rates of return over the long term are not realistic in low risk assets such as money markets, treasury bonds, or even AAA bond investments, and for the most part aren't even realistic by investing in relatively low risk stock investments such as an S&P 500 index fund. Now, in order to manage wealth and the overall value of the family enterprise, a family has 3 levers at its disposal disposal. One is it can raise returns, and we'll be talking about what families might do to do that. Second is to reduce friction, more specifically, the potentially self-destructive behaviors that lead to unforced errors and cause family dynastic wealth to disappear before its time. And third is to adopt a risk management posture. And we're going to make sure that you understand what the difference is between risk management and risk avoidance. So we're going to walk through 3 dynastic family case studies, illustrating how their growth orientation has enabled them not only to sustain wealth over the long term, and we're going to pick 3 families from 3 different cultural traditions. The Wallenberg family of Sweden from the Nordic tradition, the Mulliez family from France, and the Agnellis family from Italy and the Mediterranean tradition. All 3 families have pursued a strategy of building rather than preserving wealth. The Wallenberg family has focused on being industrial builders and infrastructure. They treat family wealth as a 100-year exercise, as opposed to what we typically see in the American stock market of quarter-to-quarter or even day-to-day profits and returns. The Mulliez family has adopted an entrepreneurial family ecosystem. They expect every member to be an entrepreneur, not simply a passive shareholder, and they embrace putting capital at risk in new ventures. The Agnellis family is a great example of strategic invention and redeployment. They don't hold on to legacy businesses just because they're part of the family history. If the businesses are not producing the return that is required to sustain the family, they divest. The Wallenberg family has been an economic factor for at least 5 generations since the mid-19th century. They see family wealth as permanent capital that is supposed to be used to build, not to be harvested. Their flagship is a company called Investor AB, which is a holding company often called Sweden's Berkshire Hathaway, with control anchored by Wallenberg family foundations. Their portfolio includes brand names you likely know, including Ericsson, ABB, and Saab. Their holdings also include various global engineering, telecom, finance, and private equity firms. Their governance is managed through 16 nonprofit foundations, largely in recognition of Sweden's tax structure, and their dividends fund science and research, not simply consumption. Each generation is expected to create new value, to leave behind a family wealth center that is more valuable than the one that they inherited, and the family office operates like private equity with a 100-year time horizon. This gives the Wallenberg family a significant advantage over conventional private equity that typically has a 10-year time horizon. By being more patient, studies have shown that investors benefit from their companies surviving for a longer period of time, producing much higher risk-adjusted returns, as over the long term, the longer a company is in operation, the more closely its risk profile begins to approach that of a bond, whereas it maintains the equity return profile. Examining the Wallenbergs' timeline is instructive. They started off in 1856 by founding Stockholm's Enskilda Bank, which is called SEB today, which is one of the underpinnings of financing Sweden's industrialization. In the early 1900s, the Wallenbergs financed infrastructure, much of which remains in operation today. By the mid-1900s, specifically after World War II, they drove international expansion of their portfolio companies, benefiting from the fact that they nominally sat out both world wars. In the 1980s into the 2000s, the Wallenberg family shifted capital towards technology, pharmaceuticals, and global services in keeping with global commercial trends. Today, the Wallenbergs are heavy investors in artificial intelligence, biotech, and deep technology via Investor AB and EQT. The Mulliez family is a somewhat more recent dynastic wealth family. They've been in business since 1955. The structure is governed by the Association Familiale Mulliez, which binds approximately 990 shareholders among a family of 1,650 family members with no outside investors. Today, they own several retail businesses that are household names in Europe, including Auchan, Decathlon, Leroy Merlin, Kiabi, Boulanger, and Nourauto, roughly 615,000 employees across that group. As a matter of philosophy, the Mulliez family recycles capital into new ventures. Members are expected to work in and launch businesses. As their economic engine, capital is continually recycled into new ventures. The members that are not already working in existing businesses are expected to launch businesses of their own. A key lesson that the Mulliez family experience teaches us is that growth comes from repeated entrepreneurship, a single retailer transformed into a diversified ecosystem. Every decade seemed to lead to a new business for the Mulliez family. The family's wealth started with the launch of Auchan hypermarkets, a discount grocery retail network. In the 1970s, they launched into sporting goods with the Decathlon brand. In 1980, they launched into Leroy Merlin. In the 1990s, they entered specialty retail with Kiabi and Boulanger. By the 2000s, they had embraced, as much as the rest of the world had done, e-commerce and digital business. And since the 2010s, they have been actively investing in venture capital deals and technology and other startups. The name of the game for the Agnellis family is reinventing itself. Their business started as an automaker called Fiat, founded in Torino right before the turn of the 20th century. Today, Fiat is one of many businesses owned by the Agnelli family, which is housed in Exor, an Amsterdam-listed global investment holding company that is still controlled by the family even though it's publicly traded. Today, their holdings include Ferrari, Stellantis, C&H Industrial, Philips, The Economist Group, including The Economist magazine, and Juventus. Over time, they've been willing to exit legacy businesses and redeploy capital toward higher growth opportunities, reinventing themselves without losing their identity. The Agnelli family has exited or divested from many businesses, perhaps more than they currently even own. They divested from their aviation business. They divested from the railroad business. They divested from Cushman & Wakefield, which is an office tenant representation business. They exited from Fiat Chrysler. They even exited from Juventus FC, which is a football club in Europe. The Agnelli family may honor their past, but they don't find themselves shackled to it, at least not economically. The Agnelli family evolved from simply the owner of Fiat to an allocator of capital. They used the profits and value that the Fiat brand built in order to later pursue an international expansion of their industrial base, to diversify their portfolio, and ultimately shifted decisively into healthcare, luxury goods such as Ferrari, and technology. They operate as a global investment holding company that allocates capital across multiple sectors. As we examine these three families, we can see some patterns emerge. Even though the ages of these families as economic actors are somewhat different, we can tell that they all embrace new venture creation. In particular, they embrace diversification and sustain a very strong reinvestment culture. To some degree, they all encourage entrepreneurship because that's where the renewal of the family business's energy comes from. They're all willing to invent themselves, and they all use highly sophisticated governance tools. Now, the routes that the Wallenberg, Mulliez, and Agnelli families took to get where they are were different, but their fundamental risk posture remained the same. Although the result has been wealth preservation, that wasn't their focus. They understood the same math that I've shared with you today. As a result, they've embraced a growth posture. They're always seeking growth because that's the only way that they can survive over a long period of time. If they don't grow, their wealth will simply die. One of the elements that ties together the family fortune is the governance structure. No one single governance structure can be necessarily considered better than another, but one thing is for certain. Families without a governance structure are far less likely to succeed over the long term than families that do have one and observe it. And we can borrow heavily from the experience of insurance companies, which interestingly are frequently among the oldest companies in the world. Governance, investment discipline, and long-term planning help insurance companies survive and thrive, not only in the face of short-term market volatility, but also in the face of global catastrophe. Each of these companies have survived natural catastrophes, global epidemics, economic depressions, and world wars. They are able to accomplish this because they've set their companies up to be able to not only survive these calamities, but actually become stronger from them. It might surprise you, given that this is principally a finance-oriented presentation, to learn that the most important reason for the failure of family businesses isn't the business itself, but the inability of the family to align on how to sustain the wealth over the long term. Data suggests that over half of the reason for multi-generational businesses to fail is simply that family members don't communicate. Another common reason for multi-generational business failures is the fact that heirs are simply unprepared for the responsibility of managing the family enterprise. And they might be unprepared from a skill perspective. They may also be unprepared from a temperament and emotional perspective. Further, the absence of a family mission means that family members are much more likely to be in conflict with one another and see themselves not as stewards of a family enterprise, but rather shareholders that adopt an extractive attitude and see the business not as an engine for the family, but for their own personal interests. Only 5% of dynastic business failures are attributed to issues concerning taxes, legal trouble, or poor financial planning. And here's where we can learn from insurance companies as a family enterprise. Insurance companies typically have 5 governing principles to ensure the proper governance of their companies over time that enable them to exist and even thrive for centuries. Insurance companies have underwriting policies that are covered in an underwriting manual. Family enterprise has something similar called a family constitution. Insurance companies have procedures for resolving claims. Thriving family enterprises have dispute resolution procedures. Insurance companies have capital policies, whereas family enterprises have distribution policies. Insurance companies have catastrophe and crisis response plans. Family enterprises have succession plans. Insurance companies have a governance manual, whereas a family enterprise has a family governance framework. When you consider that nobody would invest in an insurer or really any significant company without governance, reserves, or a succession plan, it seems strange that many successful family businesses have none of these in place. So when we mention a family constitution, what is that? Well, simply put, A family constitution is a written agreement that establishes how a family will govern itself, communicate, make decisions, and prepare future generations. Ideally, the family constitution addresses the two largest drivers of wealth dissipation. First is trust and communication. Activities that will be governed in the constitution will include formal communication processes, possibly a family council for governing the family enterprise, and regular family meetings treating them as shareholders. Second is preparing heirs. The family constitution will set forth, if not the processes, then the philosophy that one of the duties of the family is to educate, develop, and instill a culture of stewardship among members of upcoming generations so that they are prepared and are committed to perpetuating the family enterprise in future generations. The key to risk management in this environment is to focus on resilience, continuity, and protection. Resilience means that the family enterprise will be well positioned to absorb the shock, including, and it should be noted that transition from one generation to another is a shock. Whether that transition happens in an orderly fashion or if it happens suddenly and unexpectedly, it is going to be a shock to the enterprise, even under the best of circumstances, which means that continuity is key. To minimize the impact of that shock, planning the handover minimizes the risk that any kind of disruption will become fatal to the enterprise. And finally, family businesses invest in protection mechanisms that prevent any disputes, either internally or externally, from becoming an existential threat to the enterprise. So, we've learned 5 lessons today. First and foremost, growth, not preservation, sustains fortunes, as the Wallenberg, Mulliez, and Agnellis families demonstrate. Second, the arithmetic is brutal. Dilution, inflation, taxes, and spending all erode wealth by default at a rate that is much higher than a low-risk or no-risk investment portfolio can possibly replenish. Third, most wealth transfer failures stem from broken trust, communication, and/or unprepared heirs. One tool to prevent those failures is a family constitution, because these documents reduce friction and manage risk. And the great dynastic families, like great insurers, build systems, not good intentions. The bottom line is that families don't lose their wealth because they lacked opportunities. They lose it because they lacked the governance systems necessary to survive their own success. Manage for resilience, strive for growth, and prepare for transitions. A family constitution doesn't have to be long. After all, the United States Constitution is only about 20 pages in length. But we have found that the most successful family constitutions contain this table of contents. First, the mission and purpose. Why the family should continue to own the business and why it's an important element of the family's success going forward. Second, values. What are the principles that are going to guide decisions? No constitution can prepare for every decision point that's going to come along. Therefore, it is necessary to set forth a series of guiding principles that can give future decision makers the best opportunity to make the kinds of decisions that their ancestors would have wanted. The family constitution must provide for governance. At some point, decisions will have to be made, and the family constitution will describe and proscribe how those decisions should be made. Fourth is employment policy. Different families will have different criteria to decide who will work in the business and who will not. Next, a family investment thesis. The family constitution should contain a description as to how the family business will judge, pursue, and monitor investments going forward. Next, there should be some sort of liquidity policy. If a family member doesn't want to remain a shareholder and they want to cash out, there should be a mechanism to do so. There's nothing to be gained by trapping family members inside the business. Next is a dividend policy. Most family members are going to want to reap the financial rewards of the business at some point, but in order to avoid the demand for dividends becoming chaos, a good family constitution will set forth very clear rules, or at least guidelines, in how dividends will be determined and when they'll be paid. The family constitution ought to include language for succession planning. If a family business has some sort of Game of Thrones type political free-for-all every time somebody's ready to take over the business, that's unlikely to lead to the success of the business in the long term. Education requirements. Smart businesses realize that taking over the business should require more than simply having the right last name. There needs to be some sort of training process involved, or at least a minimum set of qualifications, in order to entrust such an important financial asset to somebody, including a family member. And finally, there should be some written mechanism for conflict resolution. By far, a family is much better off when they resolve conflicts internally rather than having multiple parties in the family lawyer up. In those cases, the only winners are the lawyers. The family constitution can pull two of the three levers that we discussed. It can help manage and contain family conflict. A constitution can constrain the desires of some family members to try to force a liquidity event. A family constitution will almost by default improve upon poor governance. A family constitution will help resolve shareholder disputes before they can become problematic. And a family constitution will provide a mechanism mechanism to ensure heir preparedness as the company is passed on from generation to generation. A family constitution cannot, however, mandate strong investment returns, although it can provide some guiding principles that should move the family enterprise toward that goal. So the family constitution ought to be thought of as a risk management tool. In terms of family conflict, the family constitution will provide for communication protocols and possibly even a family council so that there is collaboration in key decision-making exercises for the family. The family constitution can reduce the risk of ownership fragmentation over time by creating transfer restrictions. The family constitution can reduce the pressure for liquidity by creating buy-sell mechanisms. Again, if a family member wants to get out, there's nothing to be gained by forcing them to stay in. A family constitution can reduce the risk that a sense of entitlement could wash over generations of the family and make them poor decision makers. This can be mitigated by education and cultural requirements. Finally, the Constitution can manage risk by addressing potential leadership gaps and ensuring that when the company is ready or requires somebody to take over in a succession scenario, that there's at least one person, preferably more, that are ready to accept that challenge. It's worth noting that firms with a formal succession plan are 2.5 times more likely to survive over 30 years, yet most family firms do not have one at all. I appreciate you participating in this webinar. I'd love you to make a comment below to tell us where you agree, where you disagree. What have you learned about dynastic family businesses and wealth transition? Leave a comment below.